I appreciate you breaking down your journey
Sure.
of how you got into the VC space or the motivation behind it. What would you recommend for somebody that's interested in getting into the world of VC? How would you recommend they break into it?
Yeah. So I love this question.
Yeah.
Because it's one of the few industries where you can do the job before having the job.
Really?
Seriously. Yeah. Right. So, exception being that if you're trying to be a general partner or principal, right?
Yeah.
I mean, if you're thinking about coming in as an analyst or an associate, you're going to be sourcing deals. And
Okay.
in this day and age, there's nothing that prevents you from sourcing a deal on your own. Right?
Okay. What's let me
Yeah.
interrupt right there real
Yeah,
quick. So
go ahead.
sourcing, I've sent you a couple of people that I'm like, hey, you got to check out these guys. Have a conversation.
Really? Who?
Fareed. Remember him?
Yeah.
The,
Okay. Fair.
Beauty
Fair.
tag.
Yeah.
And then,
yeah.
oh, the other one I didn't send your way. It's a guy, he's moving back here to Houston named Jeremy Gaston.
Okay.
He has a company called Trainer.
Okay.
And so they have a platform where trainers go on the platform, they input their workouts, they connect with athletes, high school athletes, things of that nature. And the students, same thing on their end. They can do everything from scheduling, booking, paying. They can do their own like self-paced trainings in the platform, all that stuff. I haven't sent you his information, but I mentioned his name now.
Okay.
And I'll send his information your way.
It's coming back now. Okay.
But
yeah.
Is that sourcing or is it a step beyond
No.
that where it's due diligence and everything?
That is it, right?
Okay.
I mean, you can add the diligence piece to it.
Yeah.
Right. So taking the example of Fareed, for instance, right? And I don't know if we're gonna censor this or not, but interesting. No, it's so interesting sector for disruption, right?
Yeah.
I particularly love looking at uses of technology in areas where the incumbents have either become complacent or are not incentivized to change, right?
Okay.
And so the kind of technical term for this is a counterpositioned business model. So it's one of the reasons why Netflix was able to take on Blockbuster. I don't know how many times I've said people forget, but Blockbuster made, I think at one point, more than half of its revenue on late fees. People just wouldn't return their movies, right?
Yeah.
Life happens. Stuff comes up. I want to watch it a third time for my fourth date, whatever, right? And so Netflix, when they first started, was, we'll send you this thing, you keep it as long as you want. And consumers love that.
Yeah.
And so for Blockbuster to have adopted a similar type of model would have meant them sacrificing for the revenue at the time. And it was financially unsustainable, even if it was the right thing to do.
Okay.
Right. And so so the term for that is counterposition. So Netflix had a counterposition business model relative to Blockbuster.
Okay.
And so, when you identify that, like in the Blockbuster case, it's very difficult for the incumbent to outmaneuver that kind of innovation, right? Because really it's the existential kind of threat to them, right?
Okay.
So I like the space that he was playing in. My question there was the market size.
Yeah.
And this gets back to your question of returns.
Yeah.
So, funds at a certain size are not just looking for unicorns, which is a billion plus valuation, right? They're looking for decacorns to really move the needle. And so,
so 10 billion plus?
10 billion plus, yeah.
Wow.
But they exist, I mean, and you're seeing more and more of them be created just because the markets are also increasing, right? You think about so at a fundamental level, what is the market? It's the willingness for a particular customer segment to pay for a good or for a service. And then it's also the accessibility that you have as a company to address that. Okay. And when you think about, rising digitization across, most parts of the economy, markets are also just growing larger. So they can absorb those decacorns. People are raising larger funds. And so that's now becoming kind of like the new unicorn, if you will. So what that means in practical terms, let's say that I have $100 million fund, I'm really looking for a company that can get me a $500 million exit, right? And so if I'm coming in at 10% ownership, when I write my first check, maybe I'm falling on, maybe I'm not, but let's say I'm being diluted down to 2 or 3%, or let's call it 2%, right? And I still want that $500 million outcome. That means that the company has to be worth, 10 billion, right? Because 2% of the 10 billion will get me to the 500 million. I think I might need to, double check my mental math here, right? Yeah.
I haven't done math in a while,
right.
surprisingly.
So there you go. I love that. You didn't have shirts, recovering engineers,
Really?
Yeah, really.
Yeah, like people ask you,
yeah.
I got you.
So again, interesting thing that he's playing in.
Yeah.
But the question then becomes, who are the people who have funds or who have vehicles that would get excited about the upside of this business?
Okay.
And a lot of times that becomes a limiting factor for how large a company can grow.
Gotcha.
It doesn't mean that the company shouldn't exist. It just means that it might not be VC backable over the entire life cycle of the company. Which is a shame because, like if you create $100 million business, that's still an incredible outcome. I mean, that's life changing.
I'm cool with that.
Yeah, you're cool with that. I'm cool with that, right? But for a lot of folks, especially in the Bay Area, that's not going to get anyone excited. And so to your point, when I think about what are things that need to change, I also think about, well, what are different, ways of slicing and dicing the capital stack so that we can still set people up to create these kind of businesses while also, I think, being attentive to the ones that can be a multiple. So,
yeah. Okay. A
Anyway,
lot of good stuff.
So that's sourcing. Yeah.
So sourcing, so to your point, doesn't necessarily have to be deep due diligence. It could just be recognizing an opportunity and a, what'd you say, counter position?
I mean, it could be, so it's recognizing an opportunity.
Yeah.
And then it's also being articulate about why this opportunity is something to get excited about.
Okay.
So counter positioning could be one, right?
Okay.
It could be a reason why this could be exciting. Another could be an unfair advantage that the team has from a network, from a skills, from a technical, capability.
Yeah.
Right. If I'm, if we're chatting, for instance, you say, hey, Jordan, the founder of, just give me a recent unicorn here. Let's say that the founder of
Snowflake came to mind for some reason.
There you go. So the founder of Snowflake has a new idea. Right? They want to go and disrupt the data service space or something.
Yeah.
I'm going to be interested in that. Right.
So in this situation, you can do the job before you have the job. So that would be me sending you, hey, here are some startups I think you should be interested in. Here are a couple of reasons why. Is that just the introduction? And hopefully I start to get your attention enough to where you're like, hey, this guy Andrew, he's sending me actually some really good leads. Like, let me see if I can bring him in as an analyst or associate. Okay.
Exactly. And so you can go in as an analyst.
Okay.
Another common route is as a scout. And so scouts are people who can write checks on behalf of a firm.
So in terms of hierarchy, that's higher up?
I mean, it's sort of adjacent because you're not on the payroll of the firm.
Yeah.
But you get a little bit of carry, a little bit of cut on the success of that company.
Okay.
Yeah.
I like that idea.
Yeah. Right.
And I'm not going to lie. I'll talk a little bit about myself. So doing this podcast, I was like, hey, I'll meet a lot of cool people that are like working on some good stuff.
Yep.
I was like, maybe I should dabble in the VC world.
Exactly.
So I like that idea of like the scout.
Yeah.
As I find talent, especially diverse talent.
Yeah. So I think the reason why this is a good model for you is because when you think about the game that we're playing, it's a long game. And so to survive a long game, you have to be durable. And to be durable means that whatever you're doing that gives you an edge or gives you an alpha has to be sustainable, to be repeatable.
Gotcha.
So you have a podcast, you are a magnet, right? You're spending a lot of time here at the Tech Innovation. You're a magnet for a lot of people that could be interesting to a firm, right?
Yeah.
If you write, say, a newsletter or a great blog about, say, the use of AI in fintech or healthcare, you become a magnet for people that are interested in that. And so finding something that allows you to do the sourcing more efficiently or at a higher quality than your competitors is going to be an advantage.
Okay.
And firms are going to take notice of that.
I like that. So y'all look into that. Scout.
At the camera,
also doing the work before you get the job. Is there another one, real quick, a third one, maybe to kind of put a good bow on it? More traditional, I guess, like, hey, I graduated from Harvard, have this finance degree. I guess that could happen too, like just apply for a job.
Sure. So what do firms traditionally look for if you're coming directly from the workforce?
Yeah, I guess what would be a good one there?
Yeah, so there's probably 3 personas that firms like.
Okay.
And again, it's important to say, am I playing in the super early stage? So am I doing pre-seed and seed?
Okay.
Which is less financial model driven. It's more of like a soft skill sort of assessment. It's more qualitative.
Okay.
Or am I playing in the later stage stuff where it's really kind of model driven, right? The company might already have $20 million in recurring revenue. You know, there's metrics there that you can analyze and say, this is a company that we're excited about for X, Y, and Z reasons.
Yeah.
Quantitative. So if it's on the later stage stuff, profiles that people typically look for are, to your point, backgrounds in finance, right? People that know their way around the model, people that are familiar with, best in class industry metrics.
Okay.
And then people that, again, have a certain relationship within the industry that they can also be value add partners, whether that's helping secure top talent, or that's helping them think strategically about the next steps, what have you. Another profile that people also like are product managers or builders, right?
Oh, wow.
I mean, look, if you say, hey, I've been there and I've built that, fantastic. You're going to be a great mentor or a guide, not only to screen for other talented builders, but also to help people avoid pitfalls. I know we'll talk a little bit about things to avoid, right? And then the third kind of background that we also see, apart from tech, consultants. Just because they're good at distilling complex information into a digestible process.
Gotcha.
And so much again of the game at the early stage is about messaging, and there's a lot of soft elements to it that you could benefit from it if you come from a consulting background. So
nice. Good stuff.
Yeah.
Good stuff. Since you mentioned the product managers and that being a potential background that firms kind of look at for bringing in new talent because they've gone through the headaches, they know what mistakes to look out for. In your opinion, when you have founders pitching to you, or when you're just doing your due diligence, what are some mistakes that you've commonly seen founders make that kind of prevented you from investing in that company?
Yeah. I mean, there's a ton. But I think one thing that we see consistently is people underestimate the amount of competition there is out there.
Okay.
If you're seeing an opportunity, I guarantee you someone else has seen it as well.
Gotcha.
They may not be on your radar, but there's someone that's out there building what you're building.
Yeah.
Now, they might be going about it in a slightly different way. They might be having some adaptations to it, right? But not understanding where you fit within the competitive landscape, I think, continues to be a challenge. And so the question that you have to ask yourself, in addition to how do we differentiate ourselves from those that we know about, is to think, assuming that there's someone else who's building this, what is it about our strategy or our team that makes us the right ones to back on paper, right? Which means that if I look at things as is, do I get excited and say, there could be another team with X, Y, and Z ingredients, and regardless of that team, I'm going to pick this group in front of me. So I think having that sort of awareness and having an answer to that
competitive edge.
Exactly.
What is it?
Exactly.
Gotcha.
Is a common stumble. Another thing that we typically see is, people not necessarily thinking through the go-to-market strategy as much as we would like.
Yeah.
Now, you don't need it to be solved at our stage, but we do want to see some thoughtfulness around how do you scale your customer acquisition. I'll give you an example. When was doing product at a startup before 500, we made insightful observations for our customers, but the amount of time that it took us to reach those insights was still longer than it needed to be a truly VC backable type of company. And so I think thinking about, well, once we realize that there is a need for what we're building and we're seeing adoption within the market, how do we think about adding fuel to the fire, so to speak? So let's say in the healthcare space, right? You're probably, there's a couple different ways to get your service or product into the hands of consumers or businesses or patients, right? You can have a direct to consumer type of model. You can go through payers, you can go through providers, you can go through digital health companies, and they all have their different pros and cons, advantages and disadvantages.
Yeah.
So I think being thoughtful about the next step of scalability when you have some initial signs of product market fit continues to be a stumbling block for some founders.
Okay.
And then let's see, what's another mistake that we see? I shouldn't be laughing because this one is a little tragic. But,
oh, really?
Picking the right co-founder.
Oh, wow.
Man.
Yeah, I bet that's a huge one.
Man. You know?
Yeah.
Yeah. It's like a marriage, you know? And so,
yeah.
I mean, we've seen everything, man. And you know, fortunately, unfortunately, people's priorities change. And so the person that you thought was your ride or die on day one might be a new parent 3 years from now and to say, hey, I actually don't want to be spending my weekends coding. Yeah. Like I want to go see my child's first steps or something.
Yeah.
And so, you know, that's just one example. We see teams also kind of split or fragment over disagreements on on
direction,
technical. Exactly.
Model.
Yeah. But really being candid about the relationship of the co-founders and the expectations, you know, as that evolves.
Yeah.
Is another reason why we sometimes say, hey, interesting what you're building, but there's something here that needs to be addressed within the core team before we're comfortable with the next step.
Gotcha. I think people kind of see these big deals come up where, hey, ABC company raised $10 million, XYZ company raised $20 million.
Mm-hmm.
But oftentimes, I don't think people see what goes on behind the scenes and what the expectations are from the VC side of things. So what do you guys typically look for when you are cutting a check, maybe at the seed stage? If you're cutting $1 million check, what percentage of equity are you looking for? And then also, and that's just an arbitrary number, by the way.
Sure.
But then also, what are you looking for in terms of, do you typically require them to make any kind of structural changes to their team? I have seen some companies raise money and then unfortunately have to make layoffs. So what on your side in terms of expectations? What do you guys?
Yeah, so there's a lot to unpack there. So that's my consulting term for the day, right? You know,
it's a lot to unpack.
Yeah, it's a lot exactly. It's a kind of way of saying, where do I start? You know?
Yeah.
Let me first say this. Every round needs to be thought of in the context of the life cycle of a company, right?
Okay.
Like you don't do a round just to do a round, right?
Gotcha.
You do a round because you want to finance and capitalize the company with enough resources to get to the next milestone.
Yeah.
And eventually you do that enough times in a row, and then you're a publicly traded company. That's the hope. Or you have an exit, you know,
acquisition,
M&A or something, right?
Yeah.
Exactly. And so, you know, with that in mind, when we're writing a check at the pre-seed stage, right?
Yeah.
We're thinking, okay, are we giving this company enough resources to be competitive at the seed stage? And when we write a check at the seed stage, is, you know, are we giving this company enough resources to go off and raise a strong Series A?
Yeah.
Right. And so, what that could look like on a revenue perspective, for instance, is, do you understand the pillars of growth well enough where if we write you that $1 million check or that $2 million check, you can take that capital, hire a sales team, hire additional tech talent, and grow your recurring revenue by 3x to $3 million in the next 2 years, right?
Okay.
You know, that's an example of that sort of operationally. Gotcha. So what that means from an ownership perspective is there's always a balance.
Yeah.
Because you want to be compensated or rewarded for the risk that you're taking. The seed Series A, it's not a guarantee these things are going to succeed. So you want to be rewarded for the risk that you're taking, but you also want to leave enough sort of pie on the table to entice people after you. And so one of the things that, you know, to your point, what are red flags or what are things that make us walk away from a deal is the ownership is out. If someone is coming to us and, you know, they're in the very early days of their company formation, but they've already sold 30% of it to an angel or to another group, it's very difficult to get other folks excited because there just isn't enough there for it to kind of go around. So it's always going to be a balance. So I would say typically at the seed, what we see founders sell, or another word for that is dilution, anywhere between, call it 15 and 25%. So that means, you know, if we're writing you a $2 million check,
Yeah.
Your post-money valuation could be anywhere between, 14 million on the 15% side,
Yeah.
or 10 million post-money on the 25% dilutions.
Gotcha. So you said pre-seed? Seed is 15 to 20. Okay. And
that's a general rule of thumb, 15 to 20 kind of for each round.
Oh, okay. Each
Pre-seed,
round. Okay.
seed, A, etc. There are stats on this. Index Ventures has a great sort of portfolio of what ownership looks like over time.
Yeah.
And the other piece of this, again, is that you want to have enough ownership for the founders that they still feel motivated to go and build.
Yeah.
Like if you get to a point where you own a small percent of the company and your upside isn't that enticing, are you really going to be, waking up and doing the Rocky kind of montage, So
true.
So it's a
Let me ask you one quick follow up. And this might be kind of like the dilution side of things, but let's say you make that 15 or 20% investment in seed.
Yeah.
And you have round A, round B. For each of those subsequent rounds, are you as a seed round investor giving up a portion of your 20% as well, or are you permanently holding on to that for each and every round?
It depends on it varies. So it depends on the financial instrument that you've used, right?
Okay.
So if you've written, for instance, a SAFE, which is just an agreement for future shares of a company.
Yeah.
Depending on whether it's a post-money SAFE or a pre-money SAFE, you can be protected from dilution in subsequent rounds.
Okay.
Right. But once you go through what's called a priced round, so you have the issuance of actual shares, the founders get common, the investors get preferred, etc. Usually those shares are subject to dilution in subsequent rounds.
Gotcha.
Now, some firms, as their thesis, will follow on because that's what they believe they want to do to make the fund math work.
Okay.
So they'll write, initial checks to 100 companies, take the top 20% and write follow-on checks to preserve their ownership.
Okay.
Right, to avoid that dilution.
Yeah.
But the minute that you have shares and you go through another price round, generally speaking, those shares are subject to dilution, which include the founders as well.
Gotcha. Okay. Thanks for breaking it down. Like that's something that's.
I guess why the question, or like what's the curiosity? Are you hearing a lot of questions about that from the founders that you talk to? Or?
So I do get it. I do meet quite a few founders that on the pre-seed side, especially here, like at different networking and meetup events where somebody has an idea, and it's more so for my own personal curiosity.
Sure.
I figured there had to be some kind of dilution going on. Otherwise, to your point about founders, like as you're going through pre-seed, seed rounds A, B, whatever, I'm like, yo, if it's 3 co-founders and like each of us have a certain percentage, like, am I going to wake up every morning and go through that much hell for like a very, very small piece of the pie at the end of this thing when we're ready to IPO? So that's why I was like, there has to be some kind of dilution going on. Just personally curious about that. So
dilution isn't bad as long as it's offset with an increase in the value of the company that exceeds the dilution that you're bringing in, right?
Okay.
So, if I give, and I actually just corrected a founder on this earlier, he said, Jordan, what if we give up 20% of our company the next round? I said, you're selling equity. You're never giving it up. If this thing is going to be as big as you think it's going to be, you're selling it. And ideally, you're selling it at a value that's fair to the market, right?
Yeah.
So if you're selling 20% of your company, the idea is that with the capital that you bring in, you can now reach a different milestone, right? A different realization of this company.
Yeah.
Whose value is going to offset the dilution that you just sold.
Okay.
Right. So yes, it's a smaller piece overall, but it's a smaller piece of a much bigger pie.
I gotcha.
And so that's how
it's
people.
Like, do you want the whole grape or do you want a slice of the watermelon?
Okay, interesting. Yeah, we can do fruit. We can
There you go.
Well, no, that's grape or a watermelon. Yeah,
that's a metaphor I've heard somebody say. Like, hey, we're arguing over like ownership. Like, do you want 100% of a grape or do you want 50% of a watermelon?
Sure.
25%.
And then there's always that smart aleck who says, I don't even like watermelon. So and then you're frustrated.
Yeah, messing up my metaphor, man.
Yeah, exactly. Apples and oranges. Yeah.
Cool. Oh man. Okay. So
general rule of thumb, and I'll let you collect your thoughts. At the pre-seed stage, Again, this typically means that your valuation is anywhere between 1 to 10 million.
Okay.
Again, you're seeing early signs of product market fit, but
Yeah.
not at the point where you figured everything out about the model and the customer segment.
Okay.
General rule of thumb, please try and keep your dilution or the equity that you sold to less than 20% to outside investors.
Okay. Good rule of thumb.
The lower, the better.
Okay.
Yeah. And unpopular opinion, potentially, please hold off on any VC funding for as long as you can.
Gotcha.
Because the minute that you take in money, and again, we manage this money on behalf of other people.
The goal is to exit.
Yeah. And you are on the clock. So
Yeah.
tick, tick.
Gotcha.
Yeah.
One follow-up question. I meet some people that are like, hey, I want to raise money for this idea I got.
Yeah.
And like pre-seed, they're like, I got this idea.
Yeah.
For me, I'm thinking, why don't you go test it out, see if it works, kind of.
Sure.
But when is VC not a good fit?
So again, I think this varies by fund size, right? Because people, different fund sizes have different outcomes that we're looking for.
Okay.
But our litmus test, and so for every deal that we put in front of the IC that gets approved,
Yeah.
we write a deal memo. And there's a section in the deal memo, and the deal memo, by the way, is just a way for us to capture the thesis, the investment rationale,
Yeah.
right? The overview of the opportunity.
Okay.
For each one of these, we have a section that basically says, how does this company make $1 billion in top line revenue?
Okay.
And if this company has to dominate the market that they're playing in and get 80% market share to get to $1 billion in revenue,
it's not going to be a good fit.
It's not. Yeah, exactly. Probably won't be a good fit for us.
Yeah.
So,
The likelihood of that happening is not very high.
Very few industries,
Yeah.
So, think about how prevalent Airbnb is, for instance.
Yeah.
They have like 20% market share.
Wow.
Yeah.
I didn't know it was that small.
Exactly.
Okay.
Right?
Yeah.
So it's, like with the exception of being OPEC or someone or in the energy space, right? Getting to that kind of saturation is incredibly tough.
Okay.
So if you can have a reasonable market share, again, assuming best case scenario,
Yeah.
and still get it, call it $1 billion plus in revenue.
Okay. Gotcha.
And then, the last
Good.
piece here is to do it at a time scale that's also compatible with the exit horizons of a firm.
What is that,
Right.
7 years?
Yeah, I mean, there's been a little bit of a shift to private for longer,
Okay.
which just means that companies that could have IPO'd are delaying it because they want to have more control over how the company is run.
Okay.
Once you get into the public equity space, it's kind of on a quarter by quarter basis.
Yeah.
So we were just talking to a company at our annual general meeting the other day, and I don't think I'll be fined for saying this, but their revenue was 300 million,
Okay.
and they're still private, right?
Wow.
But they could have IPO'd at
Yeah.
that revenue target, right?
Yeah.
A year or two ago, but they see a benefit to remaining private. So the exit horizon, call it 7 to 11 years, I would say.
Okay. Gotcha.
You also asked about layoffs, like why do you see people raising big rounds? And
Yeah. Why
layoffs?
is that common?
So
or why does that happen?
yeah, so I feel like I just teed myself up for this segue. So we just talked about the public markets, right? Going
Yeah.
on like a quarter by quarter cadence and kind of evaluation.
Yeah.
Things can change quickly in the public markets, right? And so what might be in vogue or what might be backable also changes quickly.
Yeah.
And the reason you're seeing some of these layoffs is, again, folks are no longer funding growth at all costs.
Okay.
I mean, there was a period, and it was really a phenomenal period, 2019, maybe parts of 2020, definitely 2021, where I could give you $1 and you would turn that dollar into 25 cents. People would pat you in the back and say, great job, you're growing. I mean, Uber essentially did this, right?
True.
They took like $4 billion and turned it into 500 million, and everyone said, way to go. But now with sort of the slowdown, the uncertainty, et cetera,
Yeah.
people are shifting away from growth at all costs, and they're rewarding financial discipline. They're rewarding folks that are efficient with their capital.
Okay.
And so if you are a founder, and you mentioned you're watching this blitzkrieging kind of resources online, right?
Yeah.
Just be mindful of what investors are looking for now, because that will change, quarter by quarter, year by year, et cetera.
Okay.
So
I'm gonna come back to that point. I want to ask you. This might be the second to last question. You kind of hit on Thesis and the market changing. What are you bullish on, or what is your thesis when you're looking for investments to make? What are you typically watching out for?
Yeah, so we are in a period of the year now where we're refining that. So some of what I'm thinking about right now is still in flux.
Okay.
But I'll tell you one area that I just uncovered that was super interesting to me. Have you been following this like explosion in generative AI stuff?
Like chat,
Yeah,
GPT?
ChatGPT and all these kind of image to image stuff. Yeah. Okay.
OpenAI, yeah.
Exactly. So it turns out that the models that they used, part of those were diffusion models,
Okay.
are really good at predicting protein structures.
Oh, really?
Yeah. And so now there's all this kind of talk and buzz about the implications of that in AI-assisted drug discovery. Yeah. So
okay. I feel like I remember seeing that.
Yeah.
I don't know who did it, but okay.
Yeah. So for those who don't know, it still takes pharma companies on average $3 billion in 10 years to go from identifying a compound to actually a commercially viable drug, right?
Okay.
And despite all the innovation and money that's gone into it, if you look at the development times, and I think the FDA or someone else publishes this, it's been flat for the past 5-6 years.
Okay.
At the same time, R&D costs have been increasing.
Yeah.
And one of the challenges is that when you're first trying to identify either a target or a molecule or a compound that can fit that target, your search space is massive. Like we're talking, more molecules and compounds than there are grains of sand from all the oceans, from all the beaches combined in the world. And so to sift through that efficiently and effectively is a super challenging process. But the idea is, with some of these advances on the AI side, you can basically expedite that process or be a lot more efficient at that process and shorten that discovery time frame from, call it 3 years, down to a couple of months. So I'm not necessarily sure, what we're looking at now, but that's an emerging trend, an emerging space that I'm interested in. I'll be reading a lot about it for the next couple of weeks. And there have been a couple of AI-assisted drugs that have been discovered, I think are now in phase 1 or possibly 2 of clinical trials. And so you're seeing signs that there's actually some, like it's not just hype. There's actually some, some there. Yeah, exactly.
There's some substance behind it.
Yeah.
That's exciting. So, and I've seen, I believe AI and machine learning is going to change every industry, moving forward. So I think it's interesting that it's being used in medical discovery. We kind of talked about medicine earlier off camera. We'll probably publish that. It was some good conversation there. Okay. But yeah, I'm not surprised. So that's interesting. So I think people should definitely be paying attention to that. And I think, I would think some engineers would make not only great founders, but then also like great VC scouts and associates, because that's their language. Like they know the technology. For sure. They can kind of see what passes a sniff test and everything.
For sure. And again, as I said earlier, not all innovation has to be a technical innovation. It can be a business model innovation as well.
That was mentioned in blitzscaling as well. And that's something that kind of blew my mind, where it's like, you don't need new technology all the time. Could just be looking at it a different way. The Netflix blockbuster is a perfect example of that. I'm sure there's other ones out there as well. So that's great.
Money talks. Sometimes you just need a different language.
Yeah.
So.
Okay. Awesome.
Trademark that.
Good stuff. Hey, so last question, big picture question. I've had a great time.
Me too.
A pleasure having you here.
Sure.
We already know that there's like this great disparity between the amount of VC dollars that goes to Black founded, minority founded companies, tech startups or not. I think the highest number I found was like 1.2% of VC dollars went to Black founded companies last year. That might have just been like the first half of last year. How do we get more VC dollars into minority founders?
I mean, if I want to be cheeky, come and talk to folks like us. I back nothing but underrepresented founders this year. Seriously.
Oh, really? Nice. Nice.
But that kind of aside.
Yeah.
I think a couple things need to happen, right?
Okay.
There's not just a silver bullet or panacea here. One is, we need to do a better job of sourcing and surfacing people that are talented within the community, right? And that means being more open about what could be, right? So just in the way that I just said all this stuff about market cap, say, Jordan, that may be true, but I still think there's a path here for this company to have $1 billion plus in top line. And maybe I change my mind and I'm open to that, right? The second thing is that we need to have more repeat founders. And by need to have, I mean firms in general and capital providers need to back more underrepresented founders a second go around.
Okay.
If you ask a lot of firms, what do you look for in a founding team?
Yeah.
They're going to say people that have been entrepreneurs and who have failed and who have learned from those mistakes and are now back for round two. And so to the extent that we can collect data around that, maybe dispel, some of these biases or some of these myths, that'll be to our benefit.
Yeah.
But, and I need to look into the numbers here, but I was catching up with a Black woman founder, and she was on a list of, I think, number of founders who had raised more than $1 million, who were also female herself. And she said, a lot of the ones that she's still in touch with have left VC altogether as founders. And, we didn't get enough time to talk about what they went on to do or what they're doing now. But I look at that and I'm like, well, that's also, part of the pipeline that would otherwise be a strong signal if they wanted to come back and, go for a second. Now, again, I realize that they might not be getting the same benefit of the doubt from firms, right? Failure might be viewed differently depending on your background and stuff. I think the normalization of that, especially within the community, also has to change. I sat in on this, I think it's called Road to Billions or something. It's put on by Black Women in Tech.
Okay. And
there was a gentleman there who was speaking, quite successful guy in the healthcare space.
Yeah.
But he said it was only recently that he realized failure was okay. And so again, I think providing creative ways of failing quickly and giving people the freedom to experiment will just bolster the community. And one of the ways you do that is by changing the odds of people that can back the super early stage founders.
Gotcha.
And the way that you do that, so just kind of think of like the evolution of tech in the past 5-10 years. People that were successful in 2010 that had access, et cetera, founders 1 through 20 and 30 and stuff.
Yeah.
They're not writing checks, right? And so one of the challenges we have as a firm is to actually convince founding team to take our money instead of taking someone else's, right? But the only way you get to that sort of scenario is if you also have people of color or underrepresented communities on the cap table of companies that are doing well. And that's something that I continue to see where you might have a founding team, right, from an underrepresented background, but the people that are financing that team and the ones that will ultimately benefit in addition to the founding team are from a different community. And so there's less recycling of the capital that goes back into the ecosystem.
Gotcha.
So that's a little bit of a chicken and egg problem because you do need wealth to put wealth back in.
Yeah.
But I think it speaks to just the ongoing need to have like continuity that will build something that can kind of span generations.
Gotcha.
Within cycles.
Cool.
Yeah.
Man, my guy.
So
this has been a blast, man.
That's my hot take. Sorry.
Yeah, no.
Yeah.
This is good stuff. I think I'm gonna try to figure out a way to get you back.
Oh wow, okay.
I've already had you for like a 2-part series today.
Sure.
But it's a lot of good stuff. I've enjoyed this conversation.
Same.
I always like to give people the opportunity to let the world know if you're working on anything, how they can find you, and then I guess like if any founders are out there, how they can connect with you, all that good stuff. So feel free to take it away. I'll let you have your moment. But yeah,
I mean, there's no moment, man. I will. Well, first, if anyone knows you, I mean, that's a direct line, right?
Gotcha.
And then I'll also drop my email address or something in the comments.
Cool.
But as a firm, we're sector agnostic. We're geographic agnostic. So if you're building in healthcare, you're building in energy, you're building in fintech, you're building in e-commerce, you're building in what have you, and you're at the early stages and you're really excited about what you're doing, you have a clear vision of what you're building, come talk to us. There's never a point that's too early. We might say no initially, right? I'm just going to be transparent here.
Yeah.
But at the end of the day, relationships go a long way in this space.
Gotcha.
And so, the earlier that we can understand what you're doing, then the earlier you get credit for all the progress that you make over time.
Oh, okay.
Right?
Yeah.
And the easier it becomes for us to de-risk you as a team.
Yeah.
So don't be shy. Come say hello.
Quick follow. How many contacts do you typically, how many interactions do you typically have with that founder before you write the check?
Oh, it varies.
Okay.
In this market, we're seeing longer diligence time, so more follow-ups and stuff. But what I tell founders is no one will write you a check on the very first call.
Okay.
It's not Shark Tank. We're not Mark Cuban, we're not going to get up and say, right. Sorry. I wish that was the case. But
gotcha.
The goal is always to get the next call. And eventually that will lead to a check if things go well. So on average, what that looks like for me, 4 or 5 calls.
Okay.
4 or 5 calls, probably a call or 2 with the group partner. Yeah. And then we're sort of comfortable. So, yeah.
Nice.
Yeah.
Good stuff, man. I feel like it's a lot of good information here. If anybody's brand new to the space, I feel like they got a lot of valuable gems from you in terms of like how to be successful.
Sure.
And what that whole process looks like.
Been a pleasure, man.
Had a blast. For you guys, I appreciate you guys watching, staying tuned. If you haven't yet, I don't think I said in the beginning, make sure you subscribe to the YouTube channel, follow us on all social media platforms, all that good stuff. And stay tuned. We'll be back again next week with some more great content for you guys. Take care and see you next week.
Peace.